We're going to be talking through the implications of investor behavior today. We've got some really wonderful information today. Great guest from DFA, Dimensional Fund Advisors here, Christian Newton. By way of introduction, Christian Newton has been with Dimensional Fund for about 22 years. Christian, you can always correct me if that is off the mark, but 22 years.
For better or worse, that is the number.
For better or worse, and hopefully lots of better. And he specializes in helping financial advisors leverage specifically Dimensional's capital markets research and being able to apply that to portfolio and practice management. Before this, Christian actually spent 10 years in Dimensional's marketing group, serving as vice president of marketing with a particular focus in creating materials for financial advisors. So it's no surprise that Christian's going to have a great presentation for us today with that background, of course. He experienced the first wave of internet growth working at the consulting conglomerate US Web CKS. And he also holds a bachelor's degree in history from the University of Massachusetts at Amherst. His online writing specifically has been profiled in the New York Times and Entertainment Weekly. So lots of experience, great accolades here. Really excited to have Christian here today to share this with us. As with always, we will have Q&A throughout the presentation today. If you have questions, send them into the Q&A and we will save them for the end. And Christian will take the wave of questions I'm sure we'll have as we go through this wonderful material today. And without further ado, the floor is yours, Christian.
Dylan, thank you so much. Thank you for having me today. And I want to thank everyone for being willing to spend a few minutes with me this afternoon. Here's what I want to do. I want to examine with all of you, to me, a fascinating field, the intersection of human psychology and economics, specifically the psychology of how we invest. So I'm hoping you'll do that with me. Even in this constrained environment, even though we cannot see and hear each other, I'm going to do my level best to make this a pretty interactive session. At the very least, I want to share with you a little bit of the social science behind this field, how it applies to and can inform a lot of decisions we make, not just about investing, but also connected to wealth. And I want to share some of the research with you, even, again, to the constrained degree that we can do it in this medium, recreate some of the famous studies that inform our perspective about what it means to invest, our behavior, our psychology. That's what I want to do with you in the next 35 minutes or so. But before I do that, because I know that I have a captive audience, and hopefully you are still listening to what I have to say and seeing my slides, I can't help myself. I want to start by sharing with you just a few vacation photos. Don't worry, it will be over soon. Sharing these photos with you without any context and hopefully for a good reason. So I want to start with this photograph, which is a photo of the side of a house in Spain. Just a cute little house, a blue house. I wanted to share that with you. Moving on in our little tour, this mailbox that I chanced upon in an alleyway in Florence, Italy. I wanted you to take a look at that. And don't worry, our tour is almost over. Last but not least, I was up in the Scottish Highlands and I chanced upon this random rocky outcropping. Now, if you're looking carefully at these slides, you may have noticed these are not actually my vacation photos. I don't tend to go to interesting places like this. These are images off the internet, but I wanted to share them with you without any context for a particular reason. Now, again, as you know, we are not all physically gathered. We can't see or hear each other, but my guess is, based on my significant experience, many of you, perhaps all of you, maybe all of you, are seeing what I see in these images. I can't help it. I see a human face in the side of this building. I know there are only windows, but to me, I see the pattern of eyes, a nose, and a mouth. It's just what my brain does. And this is an even more powerful signal. All the details are filled in by my brain. Eyebrows, a surprised expression perhaps, a big boxy nose. Now, of course, a mailbox and a piece of architecture, these are designed by human beings. So it's quite likely, even probable, that they were intended to look like the human form, to trick my brain to some degree. But this is truly a random work of nature, yet I still see very strongly, if I allow myself to, perhaps the silhouette of an old man, bald head, furrowed brow, eyes, nose, wrinkles, chin, frown, shoulder. All these details are filled in. This is a version of what cognitive psychologists call pattern recognition. Seeing faces where there are none, but also seeing and recognizing human faces when they do exist. It's a really important ability that we all have to rapidly identify people we know, discriminate them from people we don't know, to rapidly identify based on expression people who may be friendly or people who may be hostile, even when they're trying to hide it. The evidence is that our brains are hardwired to see faces. And if your experience looking at these images is like mine, you really on some level cannot turn it off. You can think of it as an automatic service that your brain, that is the organ in your head, provides to your mind, to your conscious, emotional, decision-making self. And my perspective is you cannot turn it off. That is an example of pattern recognition. And pattern recognition generally is one of the sources of a lot of the behavioral mistakes that social scientists have identified in our efforts to make economically sound decisions. Economically sound decisions as they relate to spending money on anything, including investing. Now, to get us started, to get us warmed up, before I get into the heart of my argument with you, I want to share with you two books in this presentation. If this topic is at all interesting to you, both of these titles are a great way to take the next step and learn a heck of a lot more than I can share with you in just half an hour. First, I want to share with you Jason Zweig's survey, Your Money and Your Brain. And of course, Jason Zweig, a personal finance columnist for the Wall Street Journal. In the first chapter of this book, he explores the brain scan evidence that we have about how the human brain processes losses. And the evidence is this: emotion, when we experience losses, be they actual losses or even paper losses, emotion overwhelms reason. Financial losses are processed in the same areas of the brain that respond to mortal danger. The evidence here is that in the part of the brain that Jason is talking about here is the amygdala, the so-called lizard brain at the base of the brain. And the evidence is part of its responsibility is for keeping us physically safe. The amygdala at a very low level is constantly asking ourselves, am I safe? And if I'm not, if I'm in danger, what do I need to do to save myself? So if you've ever been in a car crash, even a minor car crash, it's the amygdala that gets you into a protective position. It happens automatically. You do not think about it. If you've ever been in a house fire or even a minor kitchen fire, it's the amygdala that transforms your blood chemistry to help you save your family and your pets and get out of the house to find safety. But the evidence also is when we experience paper losses as investors, the amygdala too can kick in. And the urge is to do something to protect ourselves. That can get us potentially into a lot of trouble, as we will see, as we sort of complicate our exploration of the evidence here. And what I want to do at the heart of my presentation is the following. I want to build a case for an argument that we are not as good at making rational decisions as perhaps you think. And I want to do that with some humility, obviously. Goes without saying, I do not know anyone on this call personally. So hopefully you understand that this is not a commentary on your education, your success, the soundness of your mind, the strength of your emotions. Rather, we believe this is evidence that is shot through in every human experience, every human brain. The social sciences, most of us, most of the time, are subject to biases, or we could call them cognitive mistakes that we make, ways that we fail perhaps to live up to, again, some rational ideal. I want to start with some really basic biases, and I want to activate them in really basic ways. These are not going to be particularly remarkable or even unusual. You may struggle to see them in yourself. But my guess is you will very easily be able to see them in others, even others you know very, very well, even perhaps someone right next to you right now. I want to build a case of some of the very elementary biases that the social science evidence is that we all harbor, and then build a case for some perhaps more alien or challenging cognitive biases that more often get us into trouble as investors. Let me start with a really basic one, a really basic element, I think, of the human condition, and that's overconfidence. When are we appropriately confident in our abilities? Now, again, I want to make this as interactive as we can. And of course, you can't see the other folks on this call. But what I want to do here is I want to ask you a lot of interactive questions. And what I'm going to do is I'm going to share with you the evidence that I have gathered, presenting this material to people around the world, lots of different walks of life. These statistical trends are very, very strong. So I'm very confident that the results I will share with you from previous presentations are going to be very similar if we could magically look into everyone's living room or office or kitchen right now and see what they think. Let me start with overconfidence. And I'll ask you all kind of a classic, maybe silly question. You've heard it before, but you probably never answered it in this context. I want you to ask yourself if you believe yourself to be an above average driver. Now, I'm very confident, and I have given this presentation in at least 6 countries, that a typical audience, no matter where they are, 60, 70, maybe even 80% of the people who are gathered right now would be raising their hand and saying, yes, I am an above average driver. And of course, we know statistically it cannot be the case. Statistically, if we have a large enough sample size, it cannot be that even 51% of a population can truly be statistically above average. Again, I ask that question in an interactive level just to activate our imagination, even if we don't see it in ourselves. I'm sure we've seen it in other people who probably grossly overestimate their competence in doing a task, whether it's driving or investing. Perhaps one is easier or we perceive as easier than another. But overconfidence, especially its accumulation over time, can get us in trouble as investors. Let me pivot just a little bit and ask you a different question, again, having nothing to do with investing, not yet. The illusion of control is another powerful cognitive bias that has been identified. When we have control and when we don't, it turns out, has a huge impact on how we assess a situation. Let me ask you another, just to get us warmed up, transportation-related question. The last time you flew on a plane, it could have been 2 years ago, it could have been 2 days ago. I want you to think back to that experience as you got off the plane, and I almost certainly you did safely get off that plane. You may have looked into the cockpit, you may have seen the first officer and the pilot doing some paperwork. I want you to ask yourself if on that day you had an above average pilot. Now, again, I can't see your answers. I can't see if you're raising your hand, nor can anyone else. But I know the typical audience, no one will have an opinion. It's very rare that someone says, yes, I had an above average pilot. Why is that? Well, the reasons, of course, are manifold. It was a very short-term relationship, probably just one flight. You probably don't even remember their name. So maybe you don't have enough information to say if they're truly above or below average. But I want to hazard that part of the reason you don't have a strong opinion is because you delegated control of the outcome. When we drive, we believe we are in charge. And I would argue we believe we are in charge more than we actually are, than what actually results in a safe or not safe outcome for a drive, no matter how long or short it is. When we fly, I think you will all agree, assuming we behave ourselves, we in no way influence the outcome or safety of that flight. We've delegated complete corporeal control to our body, to our safety, to the pilot, to the airline, to the manufacturer of the aircraft, as scary as it is to think about sometimes, to the federal government, which keeps track of all of the planes in the sky. We've delegated complete authority and control over that. So we know we are not in control, which I think can contribute to this difference in perspective. When we have control and when we don't, hugely shows up in investing and how we reckon our success as investors. Let me move on for time very briefly just to activate 2 more basic biases. I will not linger on them. But again, measured by economists, measured by, again, the folks who study the psychology of financial decision-making, behavioral finance, loss aversion. The evidence is we fear and want to avoid losses so much that we tend to forego an equitable gain. Gains and losses tend to need to be out of sync, out of scale, out of proportion in order for us to overcome the fear of losses. That is a typical condition for typical investors. Even further complicating these ideas, we tend to want to avoid regret. Now, what is regret? Well, I would say what regret is, it is looking back in time and assessing our decisions in the past and being preoccupied with our success or failure in those decisions, and it requires time. And the evidence is the more time we're talking about, the harder it can be for us as people today in the present to make decisions that give us confidence that we are not going to experience regret. You can almost think of loss aversion and regret avoidance as being sort of the brake and the gas, if you'll allow me to extend my transportation metaphor perhaps farther than I should. Loss aversion often means that we avoid the risks we need to take on to be successful investors, and regret avoidance often means that we will seek out investment experiences that may not be sound because part of us doesn't want to give up on what feels like a once-in-a-lifetime opportunity. Okay, really basic building blocks here. I don't expect these to be particularly remarkable. What I want to do now is I want to share with you three, I think, much more challenging and much more powerful biases. And these are really going to be the biases that I believe lead to the difficulty we can have in managing our investments, especially if we are doing it ourselves. Let me start with a bias called attribution bias. And by the way, these last three biases that I'm going to get into in some detail here, these are all connected in one way or another to the work of Daniel Kahneman. And Daniel Kahneman, who is now a professor emeritus at Princeton University, has a 35-year body of work, largely working at Stanford and Cal Berkeley. Again, one of the first people, and he is trained as a psychologist, to study economic decision-making through the lens of psychology. In fact, the only professor of psychology to have received the Nobel Prize in economic sciences. That is how foundational his work is. Attribution is all about the stories that we tell ourselves. So very briefly, attribution is all about how what we tend to do is when we are successful, naturally, who do we credit? Especially when we take on risks in our investments. And it doesn't only have to be investments of capital, like in owning stocks or bonds or other securities, trying to time the market, or making concentrated private investments. It can also apply to how we make investments of time or effort or sweat or education. Typically, I'm going to guess, for the people that you know who are very successful in life or have been successful in life, when they tell the story of that success, when they tell the story of the investments they made, again in capital or otherwise, who are they going to credit with the successful outcomes? Well, I'm very sure that you're all agreeing they're going to credit themselves. After all, they had the insight, they had the timing, they had the guts, they had either the hard work or the intellectual capacity to add value and do what they did, and they are reaping the rewards, and we're very happy for them. But the evidence is also that when people make mistakes with their investments, especially when they make mistakes in their capital investments, what they own and when, they don't tend to take credit for those failures. Natural part of the human condition, they tend to prescribe that attribution, that failure to someone or something else. And I've heard it many times when people make a bet on the market, especially a concentrated bet in one security, one stock, one sector, one company, and it doesn't work out, what they tend to say is, great idea that I had, but the market went against me. The evidence is part of the human condition is that we take credit for success, properly earned or not, maybe a dose of overconfidence or not, and we tend to radiate away failure. Kahneman's argument is a little dose of attribution bias doesn't particularly do us a lot of harm, but the accumulation of that, especially over a long investment horizon, can get us into trouble. Let me move on to, I believe, the most powerful, most fascinating bias that I can explore with you in our limited time here today, and that is called anchoring. It's all about how numbers have a powerful influence on how we make decisions. And to explore anchoring, I want to recreate for you one of Kahneman's famous experiments. It's called the Gandhi experiment. Now, this would be an experiment he would be able to conduct, he would have 300 or 400 students for Psych 101, again, at very competitive universities with people just as smart and accomplished as all of us on this call. And the Gandhi experiment is just one examination of this idea of anchoring, the power of numbers to influence our decision making. So what he would do, and I'm going to ask you all the same questions. Again, it'll be a thought experiment. You won't see the results, but I will share with you Kahneman's results. He would ask his class, just as I'm about to ask all of you, 2 trivia questions about the one-time leader of India. The first question would be an easy question. Do you believe Gandhi was older or younger than 122 when he unfortunately died, when he was assassinated? And everyone in the class picks above or below that age. And of course, they're filling out a little survey. You can participate just cognitively. I know you're all making a choice, older or younger than 122. That's the easy question. It probably will not surprise you to hear. The second question is more difficult. Kahneman asks his students, okay, putting aside the range, I want to know his age when he died, to the year. Now, when a class answers that question, naturally, they're going to collect everything they do or don't know about Gandhi, some of it well-informed, some of it probably poorly informed. Most people probably won't know the answer cold. I have met people who do. Most people are probably going to incorporate photos they've seen of Gandhi, maybe a movie about Gandhi, not even featuring, but rather featuring an actor portraying Gandhi. Kahneman's argument is we're all going to collect as much evidence as we can in order to form a conclusion, including the number that we were exposed to in the first question, 122. Now, Kahneman's going to have multiple sections of Psych 101. We don't have that today. But I think you can imagine if I had come to you first and said, hey, was Gandhi older or younger than 9 years old? And that would be the question he would ask the control group. Followed by that second question. What Kahneman is interested in is will he get a different averaged answer based on being anchored to an incredibly high number? 122 does not sound realistic, nor does 9. I have not heard of a 9-year-old that has led a nation to independence. The evidence is very strong that people anchor to these numbers. By going from 9 to 122, Kahneman was able to get his college students to add 17 years on average to their guessed age of his age at death. That's the influence of numbers on our decision making. If this sounds like a brutally effective marketing technique, I'm here to tell you that it is. Applies to investing, also applies to how we spend money in all kinds of ways. Let me share with you one more example before I get to my last bias for you today. A famous study conducted by other social scientists at the University of California at Davis wanted to examine the influence on people's buying decisions. And for one long weekend in the summer, they put Campbell's soup, not typically a summer food, on sale 50% off in every supermarket in the city of Sacramento. Now, in half of the stores, randomly chosen, half of the stores, the price is uniform. The sale is 50% off in every store. Half of the stores have an additional sign. The additional sign reads, please limit 12 per customer. Now, knowing everything we've already talked about loss aversion, regret avoidance, anchoring, which set of stores do you think moved more Campbell's soup? The stores without the limit or the stores with the limit? And typically an audience will be ahead of me here. Yes, it is the store with the limit. Why? Well, Kahneman might argue that part of us in our brain, as we walk up to that sign, we see soup as half off, and that's great. Not soup I'm going to eat this time of year, but maybe I'll get some for later. But then we see this sign that says there's a limit of 12, and some part of our brain, however unconsciously, asks itself, if I'm to understand this correctly, someone tried to buy 13 cans of Campbell's soup, and that's where this store put its foot down. 12 is as far as it goes. Now, no one's probably going to buy 12 cans of soup. I was only going to buy one, but now that I see what a great bargain it is, I don't want to regret not having this soup, pardon me. I don't want to experience a loss. I'll show them I'm not going to buy 1 can, I'll buy 2. That is a principle of anchoring, influencing people's decision-making through numbers. And whether we like it or not, numbers are a big part of how we invest. We are constantly reminded numerically of our net worth, of the situation of our investments. I have just 10 minutes to go, but I am right on time. I hope you are thinking of some questions or some follow-ups here as I reach my conclusion. I'd be thrilled to explore those with you and Dylan in a few minutes. The last bias I have for you is the most controversial, and it's another signature Kahneman bias, and it's called framing. It's all about, to me, it very successfully isolates the challenge we have in making rational, optimal decisions. And again, to me, this is very relevant to our task as investors, very relevant to our challenge as human beings. Let me share with you one of his famous experiments, the so-called Linda experiment. Now, this is an experiment from 1982. It was authored and executed along with his partner, Amos Tversky, who didn't win the Nobel Prize only because he was deceased at the time it was awarded to Kahneman. It's a word problem, and it is a hypothetical, and I'm going to share it with all of you. And again, I wish we were all together because I'd love to see your response. But what I can do is I can share the collective response that many other audiences, and of course, Kahneman's students, the conclusion that they all came to, and we'll see for each of you alone if it matches your intuition here. So this is the word problem. Linda is 31, single, outspoken, and very bright. She majored in philosophy. As a student, she was deeply concerned with issues of discrimination and social justice. She participated in anti-nuclear demonstrations. Based on that, I want you, each of you, to choose which scenario is more likely. Option 1, Linda is a bank teller. And option 2, Linda is a bank teller and active in the feminist movement. Which do you think is more likely to be the case as a hypothetical? Each of you, hopefully, in your brain has made your choice. And I will definitely tell you that the typical live audience and the typical Kahneman audience overwhelmingly prefer option 2, bank teller and active in the feminist movement. Kahneman obviously is not on this call today. So it falls to me to defend his perspective in this word problem. His thesis is the following. We take a cognitive shortcut when we see this evidence about active in the feminist movement, because of course it kind of tracks with a lot of these details that we've been provided. And Kahneman will acknowledge that largely the idea that Linda is a bank teller alone doesn't really show up in that evidence. But this is the shortcut he argues that we take, because after all, if we're really, really rational, if we're really rigorous, if we're really careful, and again, we also remember that Linda is not a real human being, we probably should pick option 1, because in both cases, she is still a bank teller. And you can see in option 2, she remains a bank teller, but there is a second term that is not an or, that is not a neither, it is an and. So she must be both things. And so if we imagine the hypothetical Venn diagram of these two scenarios, it must be the case, however infinitesimally, that option 1 is slightly more likely than option 2, even though option 1 fits with our gut instinct. Why do we, if you collectively made the same mistake that Kahneman students did, and again, they tended to prefer option 2 70, 80% to 20%. And again, let me be very clear, he did not only test this on undergrads, he also tested it on MBA students. He tested it on students who were getting PhDs in operations research in the 80s and 90s and 2000s. And if you're getting a PhD in operations research, it means that you're getting ready to use statistical evidence to make incredibly wide-ranging decisions for governments, corporations, and military applications. Even that audience chose option 2 more prevalently. Why is that? Well, Kahneman has an answer, and it, among a lot of other fascinating research, is captured in a very long, but I will say very readable and fascinating book, his popular survey of really the sum total of his academic work called Thinking Fast and Slow, published about 10 years ago now, 12 years ago now, by Daniel Kahneman. This is how he characterizes this mistake that he argues we make. It is the essence of intuitive heuristics, which I'm going to call shortcuts. When faced with a difficult question, we often answer an easier one instead, usually without noticing the substitution. And it is that lack of awareness that concerns Kahneman, and it also concerns me, it concerns Dimensional, it concerns all of us in our goal to create better investment outcomes. Why is that? Because it is so often easier for us as individual investors to go on gut. And I think there's a really good reason why. After all, I'm very sure, and again, I don't know you personally, everyone on this call, no matter how the size or scale of our wealth, it is very connected, no matter how big or modest it may be. It is very connected to our emotional well-being, to the achievement of our goals in life, many of which are not economic or financial in nature, but are going to be emotional. You might even say irrational in nature. To me, that is a natural part of the human condition, not something to be removed, but rather something to be celebrated. But the challenge for us as investors is if we take those shortcuts, if we take those emotional responses to capital markets, we can get in a lot of trouble. And this is the conclusion that I want to draw for you. Again, I've shared with you some of these biases intentionally kind of well removed from their application to investing, but all of them can show up, especially if we do not have, to me, some really important ingredients: objective advice, diversification, and an investment plan. I will come back to those three qualities. Here are some of the errors we can make as investors. Again, we can frame, that is, we can tell ourselves a story of logical decision making using a lot of irrelevant information to get us to change our minds. And a classic example is when we have gains, we tend to want to preserve the gains. We get risk averse. When we have losses, a lot of people will want to chase those losses and reverse them. That's an example of framing that can get us into trouble, because what we are doing is we are investing without a plan. Rather, what we are doing is we are investing on intuition alone. Extrapolation, the assumption that what is doing well today, or to be more careful, what did well in the recent past, will continue to do well in the future. Sometimes that is true. Oftentimes it is not true. Can that get us into trouble as investors? Indeed it can. Hindsight. Events in the past do not seem scary or fraught with uncertainty, as you all very well know, for what feel like an obvious reason. They are in the past. They are frozen forever in time. We cannot lose investments from those events. We cannot gain investments from those events. Familiarity. Often we take a shortcut of only wanting to invest in companies, sectors that we know or are close to us. That can create distortions for us as investors. And lastly, attribution bias. Again, the sum total of all the decisions we've made in life can give ourselves a distorted view of our success as investors. In fact, I would argue often the better we have done in running a concentrated business, of being an executive in a company, the more it can be difficult to not apply those same ideas where we indeed did add value, to not be able to do that to capital markets. Let me hit my closing argument for you, and with your permission or without, I want to take you back to an unpleasant month in a somewhat unpleasant year, and that would be March of 2020. It was an unpleasant year for me. I'm sure it was an unpleasant year for all of you. I hope not too unpleasant. But I want to go through the following thought experiment, because I think it's very relevant to the benefit of, again, diversifying, having an investment plan, and having objective advice. The best way, I believe, to put to the side, the more we know, the better, but also to put to the side a lot of these biases that we've talked about. Let me ask you the following kind of scenario. And I talked to many people in March and April and May of 2020, spending a lot of time, in fact, in this very room, in the basement of my home, talking to people about our perspective on capital markets, not knowing what would come next. And a lot of people saw cover stories like this in The Economist. This was March 21, 2020. And they said, I can't take the heat. I got to get out of the kitchen. My intuition tells me what just happened is going to continue to happen. Or this is a situation that's so alien and fraught and risky for me, I no longer have confidence in investing. A lot of, again, behavioral responses. The day this issue was published, investors had already experienced an incredibly discounted drop in the value of their paper wealth, at least as measured by the Dow Jones Industrial Average here, dropping more than 20% in just a single market day. When this issue was published, markets were now down at 18,500 as measured by the Dow Jones. This is the heart of the thought experiment for all of you. For those folks who said, I got to get out, this headline is too scary, I asked them a question: what will be the cover story that tells you it's okay to get back into markets whenever that shows up? And without fail, most of the people back in March and April and May of 2020, it may sound quaint now, but most of them said, it's this: I want to see that the vaccine is here, it's in arms, it's been approved, it's safe, and everyone on the planet takes it without asking a lot of questions, and we can get back to regular life. Now, as you know, it was not that simple. It continues not to be that simple. But to me, this was a reasonable headline to look forward to. And indeed, that headline came to pass just 7 months later. There it was on the cover of The Economist again. Now, this is the crucial part of the thought experiment. For investors who did not have independent advice, who did not have an investment plan, who were not diversified, for investors who had responded to this crisis, who were waiting for a sign that it was okay to invest again, it was okay to avoid the incredible uncertainty of 2020. Do you all think that markets were waiting around at this price for those unsure investors to wade back into the markets in November? I think you all know what that investment year looked like. Not only had markets recovered by the day this issue was published, they had now exceeded the all-time high that we had experienced in January of 2020. That was how violent the drop and violent the recovery in both directions. It was too fast for us to get ahead of in reading a magazine. And I want to argue for investors who stayed invested, worked their plan, had objective advice, they got that positive return, not despite the uncertainty, but because of it. And that's where I want to close with you. And I hope hear questions or comments or objections that you might have, if I can provide some additional perspective. The goal of this presentation is not to turn you into rational robots. Far from it. Rather, I think, again, the reason we make these cognitive mistakes, to me, is because they actually make life more joyful, more bearable, more emotionally stable. They may be irrational, they may not be logical, they may frustrate economists and finance professors, but to me, they make the human experience more joyful. We don't have to ignore those shortcuts. But what we can do as investors is we can be equipped when the next thing happens, whether it is good or bad, whether it pushes stock and bond prices up or down, we can be ready to withstand that uncertainty. The choice you all have as investors is to have an advisor like Mariner that does provide objective advice. They are not captive to any one philosophy, any one asset manager. They do articulate an approach where the plan is in charge. The plan responds such that an individual investor does not have to, and typically takes the view that we want to be well diversified in all markets at all times, because markets move so quickly. It is really dangerous to try to avoid those bad returns and only seek the good returns. The experience that Dimensional has seen is that those who succumb to these biases and manage their own wealth, even if they feel better on the day, will suffer in terms of their total wealth over time. The value of independent advice means you have this choice as an investor. You have a choice to ignore the media, especially when it is supremely negative, as it often feels today. And you have a choice to ignore the shortcuts that your brain is in the habit of taking, because it's our belief that those reduce the likelihood of investment success. I want to thank you so much for your kind attention on these ideas. Again, moving very, very quickly, like a stone across a pond, over a very deep well and subject matter. But I hope this did activate your imagination of the relevance to your investment experience. And I hope you got a couple of good books to read if you want to go farther in there. With that, I want to invite Dylan back up here and see if we have any questions, any additional stuff we can talk about, even outside of the scope of this presentation itself. I'm happy to give it my best.
Yeah, what a wonderful presentation, Christian. Thank you again for being here today. Again, Q&A is open. One thing that in doing these webinars and having done them for a while now, I watched a lot of Q&A. And usually you can tell a presentation's going well when you're answering the questions before they've been asked. And that has definitely been the case today. We've had a number of questions come through, all of which have been answered in the course of the conversation that you had today,
okay.
which was absolutely mind-blowing. What a wonderful, just absolute stamp on the quality that you're doing here, Christian. A couple questions that I think can help lend to the conversation is when we're looking at how to essentially protect ourselves from our own cognitive biases. You talked about getting with an advisor that's able to help you put together a plan. DFA works with a lot of advisors. Mariner is not the only one.
For sure.
What have you seen with advisors and their ability to plan that's really made them a center of trust to help people protect themselves from their biases versus ones that maybe weren't as successful at doing that with their clients?
That's a great question, Dylan. I mean, there's a lot of directions I can go there, but I'll start with what I think is it perhaps sounds really basic, but to me, it's an elementary part of the objectivity that an advisor can provide. And let me just linger on that idea because it's a single word and it maybe sounds kind of obvious, but to me, it has true value, right? The fundamental benefit of an advisor, Dimensional cannot do it. It is not Dimensional's business. The fundamental benefit of an advisor is that objectivity. Put bluntly, your wealth is not their wealth. And my thesis is we can't fake objectivity. If it's my wealth, if it's my future, if it's my family's future, I'm going to have emotions and biases in there. Even though I present this material for a living, I know that I'm going to be subject to those biases because I cannot fake objectivity about myself. But a third party can, because it is not their money. I mean, the analogy that I like to use, perhaps not too graphic for our audience, is even the world's best surgeon, if they have appendicitis, I don't believe they asked for a mirror and a scalpel. They will in turn turn to another surgeon to execute, to perform that surgery because they cannot be objective about themselves. So with that philosophical statement being said, I think a very practical benefit of that objectivity is that the advisor can walk someone through, again, the relationship between two very powerful poles, where you want your wealth to go, how much you want it to do in your life, and what your asset allocation looks like, how you expose yourself to different investments. To maybe I'll put it even more plainly, what stocks you own and why you own them, what bonds you own and why you own them. If you own muni bonds, why you own muni bonds. There's so many considerations that are going to go into what you own and why. And to me, the ultimate goal is to achieve, the ultimate task is for the investor to achieve a long-term goal. And so I think the number one thing that advisors do is they help a client to breach that gap of time. Because I don't know about you, but I have difficulty thinking about what I'm going to do Friday night, let alone what I'm going to do with my wealth in 10 or 20 or 30, or I hope 40 or maybe even 50 years. For me, I'd love to be around spending money in 50 years. Those time frames, I think, for us as human beings are very difficult to handle. An objective advisor can be really good at bringing to bear a lot of statistical evidence to help people understand, what do I own and how likely am I to achieve my goals, and to give me confidence, especially in times like March of 2020, where what we experienced was incredible volatility, an incredibly rapid drop in our paper wealth, and one, if it had stayed that way forever, surely would have changed the financial lives of everyone on this call.
Yeah, absolutely.
Which is not to say that advisors magically make it not last forever. That's the nature of uncertainty, but rather to give people enough confidence that their plan is ready for drops, the same way a good investment plan is ready for growth, sometimes sudden growth. And again, that's why as hideous as 2020 was, I find it useful for us to go back to as investors, because now we know, knock on wood, largely the pandemic hopefully is not affecting anyone on this call at a health level. So we can look back at that and we can examine it as investors. If we did nothing, did our plan help us to do nothing? That is, not make changes after those negative events, such that we could experience the run-up when, if I can make a caricature out of it, we were able to bend the curve. The therapies and vaccines did allow most of us to go back to regular life, very thankfully, and it allowed a positive outcome for investors, not over a decade or even 4 or 5 years, but over 7 months. That's how fast capital markets can go, and they can go in both directions. That's a very long-winded answer. I apologize for that.
It's a great answer, and
it's all about kind of time.
It's that time to action. And from what you're talking about, it really comes down to being able to contextualize two things. One, the plan, right? Your needs, what you need to accomplish, and contextualizing that within the existing world landscape that we're seeing, whether it's economic, political, medical. and
Mm-hmm.
also to contextualize your emotions. Because one thing that I really enjoy that you did, Christian, is you didn't villainize the emotions, right? They're there for a reason.
Oh,
A
yeah.
lot of these emotions in separate context are there to protect you. And from what you've shared, having an advisor is important to help contextualize those emotions as well. Because sometimes it's important to be scared. It keeps us alive and healthy sometimes. Other times it can help us to unfortunately make bad decisions, right? It's not
Yep.
really helping at all. So having an advisor to help contextualize that emotion and contextualize that within the plan and the landscape, the economics that we're seeing can help make sure that we're staying on the right path or making the appropriate adjustments as needed.
Totally agree.
Now, a couple follow-up questions here.
Please.
One is just regarding the books. There were a couple books mentioned. Would you be able to make a note of what those are again? A few
I'd be
that
happy
the
to.
audience
I mean,
members were
I'm
asking.
just gonna step back in my slides if that doesn't disorient anyone too much. So, Jason Zweig, ZWEIG, Your Money and Your Brain. That was published in 2007. Shorter book. It's a fast-moving survey again of behavioral finance. Again, that intersection of using psychology to measure how human beings make decisions and how it relates to economic and financial decision making. And again, to me, that's kind of maybe the 100 level read, faster, easier read. And then you get into Kahneman. And again, like Thinking Fast and Slow. I probably have it around the corner here somewhere. I don't know, 800 pages. It definitely keep a door open. It looks impressive on a bookshelf. But if I'm able to read it, everyone on this call can certainly read it. And what I'd say about it is that it is very exhaustive. He basically walks through his entire academic career, but he brings them to life with a lot of really incredible stories and examples. And again, if this presentation was evocative for people, the largest debt is to this text, because not only, again, the fundamental research, but also his capability as a storyteller to bring these ideas, which can often be very counterintuitive, to life. So Thinking Fast and Slow, more like a 300 level read, but definitely looks better on a bookshelf, if that enters into it for anyone.
That's great. That's perfect, Christian. Thank you. Now, one question that I thought was interesting is more on a decision-making level. The question was, when it comes down to making a decision, what do you see as the most common reason that investors tend to freeze up on making a decision, whether it's to invest or not?
I think I think people have that concern when they feel like there's an elevated dose of uncertainty in capital markets in the world. Sometimes it's an elevated dose of uncertainty in their lives, but I would say more often, at least when I hear about it, it's going to be because their perspective, and let's take right now, their perspective is going to be, well, 2020 was bad, and then there was sort of this melt up, and then things kind of went sideways, kind of negative, but more or less went sideways over 3 years. But I still feel like there's another shoe to drop. And everyone talks about the inevitability of a recession and a collapse and issues in bond prices, and especially in my bond portfolio. Given all these uncertainties, maybe this year isn't the right year. This year, I'll just keep my powder dry. I'll just wait. And again, I say this with humility because I don't know any individual's situation. That's what an advisor does, is they know enough detail to know if there is stuff in there, to your point, very well said, that are emergencies that do need to be responded to, because those can, of course, happen with our wealth, especially as it relates to what technically I'd call our human capital. That is how we're earning or developing wealth, whether it's concentrated businesses or a profession or what have you. But all this is to say, I do believe that, again, when people feel like there's a big dose of uncertainty, some of them feel like, well, let's just wait for that to settle out. Once that uncertainty is done, then it'll be safe to jump in the water. But my observation, with humility, hopefully the rest of you agree, there's always been something to worry about. And I was a child of the 1980s, and I was worried about nuclear holocaust, not to put too fine a point on it, something which is more or less outside of the scope of financial markets. Can it happen? Yes, it can happen. Will we care about financial markets afterward? Probably unlikely. But I feel like there's always been things in the world to be fearful or worried about. Doesn't mean we can or should not be fearful or worried. But my take is, if I spend my investment lifespan waiting for the ideal year to invest, two observations. One, I'm probably never find it. And if I do find it, how expensive will securities be for me to get in? Because I would ask myself, if we have perfectly pristine horizons into the rest of the future, who would sell the position to me? So my thesis always goes back to, again, if we are fearful, if we are uncertain, a talented advisor can build that into a plan. That may mean our asset allocation is more modest. It may mean, to put it bluntly, that our goals are more modest. It may mean that we're not going to buy a speedboat, and we're going to give that up in order to benefit from being able to sleep at night, having surety that we can cover the basics for ourselves. And I think often, typically for people, they're really in, whether they actually have children or grandchildren, or if it's through charitable endeavors, they want their wealth to do something after they die. So I feel like no matter what it is, I feel like if we wait forever for a perfect opportunity to buy, that's never going to happen, and we can run out of time to allow our wealth to grow. So to me, it's all about finding the amount of uncertainty that we can handle. And I think if we really reflect upon it, and again, I'll go back to my perhaps weird citation of growing up in the 80s, there are always really scary things that can create trouble for us. Some of them are global in nature, some of them are right in our own families. But I don't think those should stop us from still, it's like Warren Buffett often says this: you don't have to be an optimist to be a good investor, but it sure does help. And I agree with him there. I do think you need to have a dose of optimism, not just about your own wealth, but about the human condition and planet Earth and all the countries, and hopefully our ability. Saying this, right now I feel like we have 1.5, land wars going on around the world. That we should hopefully have a dose of optimism and not be kidding ourselves. I think that does help us to be successful investors and to sleep at night.
That's great. Now, last question, similar vein. You mentioned Warren Buffett, right? Great example.
I did.
Extremely famous investor, right? Everyone knows the name, even if they don't know investing.
Sure.
Even investors like Warren Buffett can fall prey to these biases at times and make mistakes. So the question that we've been asked is, how does an investment committee, and with your experience, maybe you can talk to DFA's process as well, how does an investment committee properly create checks and balances to make sure that they don't fall prey to these same pitfalls?
It's a really important question. And if you read Thinking Fast and Slow, Kahneman has just as many examples, not to start my answer off in a pessimistic note, but he has just as many examples of how organizations and committees fail to make more rational decisions. Because again, every company at the end of the day, or every organization, is still made up of people, at least for now, right? Until the robots get a vote. So there is that danger. So what are the protections? Well, I'll speak to what dimensional is all about. And our perspective is to say that, again, we want to be econometric in our perspective. That is, we want to use the information that's in prices every day in order to structure our portfolios. We don't want the choice of what's in a particular strategy to be a function of any one person's gut instinct. Rather, what we want to have is, we want to have a team of people that do make collective decisions, but we also want to use data to inform those decisions. The best analogy I have, which I hope people appreciate here, is that if I hire an architect to build me a house, hopefully I'm not disappointed that they use a computer to draft what it's going to look like, even though the architect is informing it with his or her experience, opinion, skill, etc. It's going to be kind of a marriage of a human being and a lot of data and a lot of computing power to hopefully create something that is both good and sound and a good architectural project. It's the same thing we do at Dimensional. Every day, whether markets go up or down, we are incorporating that information in our portfolios, and so that's something that happens rapidly every day. But on the other end of the spectrum, when it comes to making really big decisions, we want human beings to inform that. And when I say human beings, I'm not only talking about the traders and portfolio managers and researchers inside Dimensional, but also a lot of the academics, not Daniel Kahneman, not the academics we talked about today, because behavioral finance is just one field of finance, but a lot of the academics who are central to pioneering innovations in finance in the last 40 years, who are on our board, who are on the fund board. And if you're on the fund board, it means you supervise the investments for the benefit of clients. So the fund board looks out for any investors who are in a dimensional strategy on this call. We want to bring a lot of people together, but to use data to make sure that we're not succumbing to these biases to the degree possible. But again, it is the human experience not to fully remove them. I believe by acknowledging them and being aware of them, we can put in controls that can make sure that we don't unconsciously fall to them.
Beautiful. Very well said. Thank you, Christian, for going through those questions. We've reached the last of the questions for today. Just as a reminder for everybody, if you have further questions, reach out to your advisor. Talked a lot about advisors today. That's what we're here for. You can message us directly. Again, thank you to Christian and the DFA team for being here, helping us put this together. This has been an absolute pleasure, and looking forward to doing more of this in the future.
Thanks, Dylan. I had a blast. Thank you, everybody.
Take care, everybody.